We're going to test one of the most popular strategies on the internet for trend following, and that is the crossover between two moving averages. A moving average is basically a low-pass filter that converts the price into just a signal that's technically speaking without as much noise, so it's easier to trade moving averages than the actual price. Obviously, a lot of people prefer to trade the price action, but that's not the topic right now. So for simplicity, we're going to use the Dow Jones Industrial Average on 4 hours, and we're going to use the moving averages on 3 periods and on 30 periods. So basically, whenever the 3 period moving average crosses over the 30 period moving average of 4 hours, obviously, we open a long trade. So this would be an example of opening a long. Here we would go short because it crosses under just slightly, and then we would go long again. And this would be, let's say, a better example of a short. So we would open it here and we would close it here. There's no stop losses involved here, so we're just relying on the pure predictable capabilities of the moving averages. So we're going to use Zoro to backtest, and we're going to see how it performs when we go long and short versus just long, and to see whether there's any differences. Naturally, this is not any financial advice, and it's not a strategy that I would personally trade, so just take it as an educational example. We are using Zoro for creating our strategies. The code is C-Lite. The platform is free, you can get it on the internet. You need a Windows machine to use it. As you can see, basically we're just using the crossover and the cross under of the moving averages to go long and short, and we're using the free period and the 30 period on 240 minutes, which is 4 hours. So basically, when we run the test, it takes a few seconds, and just by analyzing the results of going long and short, we can see that the annual return would be 20.2%. We'd have 378 trades, and we'd win 28% of the time, roughly. One of the characteristics that you need to factor in whenever you're testing or trading a trend following strategy is the fact that your win rate will be 30, 35%, 40%, but not more than that. So whoever claims they're going to win 80% of the time, they probably have a mean reverting strategies, or they're just purely lying. Now let's look at how the trades perform. So the green ones are the wins and the red ones are the losses. So basically you could see here at the crossover it went long, it won it, it closed it at the crossover, cross under, then it went short. But since the Dow Jones is quite a bullish instrument to follow, then the short lost. So this area that you can see here marked in red is what's called the drawdown, and if you actually look at it, it's at the beginning of 2020, once the COVID kicked off. It identified quite nicely the top and it went short, it won the trade, so it had a few good shorts where it won. Naturally, as I was saying before, there's no stop loss here, so you're simply relying on the crossover and cross under and on the predictive power of the low pass filter, which in this case is the moving average. Naturally, I wouldn't do that in real trading. Now let's look at the results a bit. So one of the most important aspects here is the maximum drawdown. So as you can clearly see here, the maximum drawdown is 106%. Now that would definitely put you in a margin call. So even without any leverage, you would lose your money and more. So as I was saying before, the percentage of wins is 28%, which is quite natural for trend following strategies. And the Sharpe ratio, which is basically the ratio between the returns and the volatility, is 0.28, which is not particularly great. You'd want to see something closer to 1. Naturally, we've only tested this for the last 4 or 5 years, so that's not very relevant in terms of what's going to happen. Normally, you probably want to backtest over the last 25, 30 years, if not more. And you can also see the standard deviation of your strategy. So whenever you've got any sort of standard deviation greater than 50%, you just need to stay away. Because simply put, you can make 50% this year, but next year, if you're within 2 standard deviation, that means 100%, and you lose everything that you've got in your account. That's pretty much the margin call. Again, this is the long short version. And let's just quickly change it to see how the long only version would work. Again, this is without optimizing any parameters, so we're not necessarily trying to fit the curve any better. So we're just using the 3 and 30 crossover. As you can see, the win rates improved slightly, and there's fewer trades because we're long only. And the Sharpe ratio is also improved. It's 0.51 now compared to 0.30. So annual returns also improved, and as you can clearly tell, it stopped losing money. So some of the other years it was in a drawdown, and the overall drawdown has also improved. So instead of 100%, it's now 50%. Naturally, still this isn't in a final form, so can't necessarily rely on the predictive powers of the moving averages to carry on in the future. And it's just an educational example. So as you can see, the standard deviation is quite high still. So it's not 70+%, but it's still 65%, and that's not really impressive. So that means this year you can make 65% as it's done, but next year you could lose 130%. So be really careful with these strategies and the claims that people make. Now, just for the sake of the example, let's introduce a stop loss, which is volatility based. It's basically an ATR of 30 periods, and we place the stop loss at 2 ATRs. So basically 2. And let's see if there's any change. It's improved a bit, as you can tell. So the Sharpe ratio has improved to 0.59%, and the annual return has also improved by 3% by keeping the same number of trades. Now let's look at, that's pretty much the standard deviation. This one has also improved. It's 61% now instead of 65%, and it's not lost money on any years. But again, I wouldn't trade this one. Now, out of curiosity, a lot of people might be interested on how this works on Bitcoin. Let's have a quick look. Just test it in this form. So long only strategy of crossovers would result in a 60% annual return. So if we had the look, we've only got data for the past 3 years. So 2018, lost money, made some money this year. The standard deviation is not particularly high, but then again, we've only got data for the past 3 years. And as you can see, you've got a pretty much long period of a drawdown here. So from August until arguably August the next year. So that's 1 year when you would be in drawdown. Interestingly enough, there's one aspect that people sort of ignore, and that's the maximum drawdown. As you can see here, it's 109%, which is huge. You would basically lose everything. And the other one is the total downtime. So just for the sake of the argument, running the algorithm again on the Dow Jones long only strategy, you see that the total downtime is 80%. And that's a characteristic of all the indices, even though they are trending. But whenever you trade them, or even if you don't, even if you're on a buy and hold strategy, you'll still have a downtime of 70-80%. So you'll be underwater pretty much 70-80% of the time. If you've got any other strategies that you would like us to test, just put your comments below and we'll have a look at them. We're going to try and create more of these examples with different indicators to see if they've got any predictive powers. There's clearly a lot of people on the internet claiming buy here, sell there, but they're just cherry picking examples, and that doesn't mean you're going to make any money. So give us a thumbs up and add your comments below. Thanks, bye.